In July 2026, new superannuation laws are coming into effect that could see you accidentally breach your contribution cap and get hit with a surprise tax bill. It's called the Payday Super Trap, and most Aussies have no idea it's coming. In this video, I'm going to explain exactly how this trap works, who it affects, and the steps you can consider to legally navigate these changes. Welcome to SMSF Insider, where we help busy professionals to gain financial independence using an SMSF. Hi, I'm Troy, founder of Blue Chip SMSF Services, and over the last 20 years, I've helped thousands of Aussies manage the complexities of self-managed super funds. And in this podcast, I'll answer your questions, break down the myths, so you can take charge of your financial freedom. Let's get into it. Just a quick disclaimer before we dive in, this is general information only about upcoming changes to superannuation law. It's not financial advice. Whether any of these strategies are right for you depends entirely on your personal circumstances, and you should speak with a licensed financial advisor before making any investment decisions about your super or your super contributions. Okay, let's get into it. So, what is Payday Super? Right now, most employers pay your superannuation guarantee, or SG, on a quarterly basis. But from July 2026, new laws will require employers to pay your super at the same time they pay your salary or wages. On the surface, this sounds great. Your money gets into your super account faster and it starts earning returns sooner, which is great. But this change creates a hidden trap for anyone who is actively trying to maximize their super contributions. To understand the trap, you first need to understand the concessional contributions cap. In Australia, you can contribute up to $30,000 per year into your super from your pre-tax income. This is called your concessional contributions cap. These contributions are only taxed at 15%, which is usually much lower than your marginal tax rate. For high earners, maximising this cap is a key strategy to legally reducing your taxable income. But if you go over this $30,000 contribution cap, the excess amount is taxed at your marginal rate, plus you can get hit with extra penalties. And this is where the Payday Super Trap comes in. Here's how the trap works. Let's look at the 2026-2027 financial year. Because of the switch to Payday Super, something unique is going to happen in July 2026. In that month, you'll receive your super contributions for April to June, which is April, May, June quarter of 2026, which would have been paid quarterly under the old system. And you will also start receiving super contributions with every single paycheck for the rest of the financial year under the new Payday Super system. This means in 2026-2027 financial year, you could receive up to 15 months worth of super contributions in a 12-month period. If you're someone whose salary sacrifices right up to the $30,000 contribution cap, this extra 3 months of contributions could easily push you over the limit. Let's say you earn $150,000 a year, your employer SG is $17,250, you salary sacrifice an extra $12,750 to hit your $30,000 contribution cap. But in the 2026-2027 financial year, that extra quarterly payment from the old system could add another $4,312 to your contributions. Suddenly, you've contributed $34,312, you're over the cap, and you've got a surprise tax bill from the ATO. Just quickly, guys, if you're a busy professional, fed up with traditional super funds and overwhelmed by the setup of your SMSF, we can help. Book in a call with my team using the link in the show notes, and let's build your future on your terms. Now, back to the episode. This trap primarily affects two groups of people: high earners who are actively salary sacrificing to maximize their $30,000 contribution cap, and anyone with multiple employers, as it can be harder to track total contributions. If you're just relying on your employer's standard super guarantee, or SG, and not making extra contributions, you're probably okay. If you are being strategic with your super, then this is something you need to be aware of. So what can you do? Again, this is not financial advice, but here are some strategies that people may discuss with their financial advisor. The first one is adjust your salary sacrifice in the lead up to July 2026. You may consider adjusting your salary sacrifice amount for the 2026-2027 financial year to account for the extra contributions. The second one is the use to carry forward rule, which is the government allows to carry forward any unused concessional contribution amounts from previous years, from the previous 5 financial years. If you have unused cap space, you could absorb this with the additional contributions to prevent a breach. And thirdly, monitor your contributions. So keep a close eye on your super contributions throughout the year, especially in that transition period. Don't just set and forget. And finally, speak to your employer. Understand exactly when your employer will be making the final quarterly payment and how the transition to Payday Super will work for your specific payroll. This is one of those situations where having an SMSF can provide a significant advantage. With an SMSF, you have complete visibility and control over your contributions in real time. You're not waiting for an industry fund to update your statement. You can see exactly what's coming in and when. This level of control makes it much easier to manage your contributions and avoid accidentally breaching the cap. At Blue Chip SMSF Services, we set up your SMSF with a compliant structure from day one, giving our clients the framework they need to manage these kinds of complex situations effectively. We can have your fund structured and everything completed on our end in just 5 business days. The transition to Payday Super is a positive step for most Aussies. But for those being proactive with their retirement savings, it's potentially a minefield. Don't get caught out by the 15-month contribution trap. Review your contribution strategy, understand the rules, and make a plan. Remember, this video is general information only. Whether you should adjust your super contributions or set up an SMSF depends entirely on your personal circumstances. Speak with a licensed financial advisor to get advice tailored specific to your situation. If you already had that conversation and you've decided that an SMSF is the right path for you, then Blue Chip is here to help you get it set up and established quickly and efficiently. Visit our website to learn more. Links are in the show notes below. Thanks for tuning in to this episode of SMSF Insider. If you got value from this, make sure you subscribe so you never miss the strategies we share to help you take control of your financial future. Find us on socials at Blue Chip SMSF or book a call with our team to see if we can help you.